Hello guys, here is another problem, which is problem S, problem of risk tolerance. Now, each trader has a different risk tolerance. This has nothing to do with stop loss. Now understand, when I say risk tolerance, it is your risk tolerance. It has nothing to do with the stop loss. This is you and how you feel about risk in general. If you buy a stock before the earning date and you know you might have a gap up or gap down and you do the trade, here it means you have a high risk tolerance. That means if you lose 10%, you are not going to cry the whole day. This is what I want to explain. There are some people who don't like risk that much. And there are some traders who like risk. Like more risk. These are two types of traders, and you should choose. Now choosing is very simple. When you do this trade, for example, earning date, and I will tell you, you might have 10% up or down. Do you accept it? Yes or no? You say, okay, I accept it. Okay, you do the trade, and if you lose 10%, you will be okay. You are not going to be whining, or you will be crying the whole day for losing some money in the market. Okay? Now, if on the contrary you are not comfortable losing too much in a risky trade, you should find ways not to trade risky stocks. It means you should do something about it. You don't like risk, too much risk. I'm not saying risk, because in any trade we have risk. But let's say you don't like risky stocks that move and swings too much. You should avoid stocks that have a gap up or gap downs, because news can come at any time and make you a big loss that you can't support. Now you, for example, you don't like to lose 5% or 2% or 10% in a trade. Now, if you see a stock that it is having gap up or gap down, why you go and you trade it, although you know it is risky stock, but you go and you do it. Either here you don't know how much risk you are taking, or you just want to hope that the stock doesn't go down. And understand that if you begin to hope, you have no place in the market to be a trader. There is no hope with the trader. Either you know your risk or you don't know. If I am telling you that you can make 15% or 20% in this trade by profit, or you can make a loser by 20%, do you accept it? Yes or no? It could be more, it could be less, because no one knows. So don't hope. When you buy a stock, don't hope it cannot go down. If you hope, it means you are not having a strategy, you are not a good trader. Also, you should avoid stocks that are volatile. That means that can go fast in both ways, up or down. If you see a stock that goes $3, $5 a day, understand that this stock can go up very quick and it can go down very quick. Understand both ways. Okay? So don't see just the up, which you will make money, but you don't see the down, which you will lose money. Understand both ways. If you see these kind of stocks, if you want to trade them, that means that you like risk. But if you don't like risk and you go to trade them, you are mistaken. You are doing something against your risk tolerance. The solution is to trade for real and see how much risk you can take in each trade. This is determined by you only. It means no one knows you than yourself. You know how much risk you can take. It's not another trader or your teacher or another person or a friend who tells you how much risk you take. It is your decision. Either you take risky trades or you take not risky trades. The only way is always plan for your trades and see if you can handle the stock. Although you can be safe when trading stocks, but you can limit the risk according to which level of risk you want, which is always in your hands. It means controlling the risk is in your hands. That's why some they buy mutual funds and exchange traded funds because they don't move that much, and some sectors that don't move that fast, either up or down. You can see some stocks and you see they are not doing that much, either up or down. So if you like this kind of stocks, you always stick with this kind of sectors or industries and trade them. At least when they go down, they don't go too much, and when they go up, they don't go too much, and you are safer than before. It all depends on your age and what you want to risk in the market. The good thing is you are always the one who plan and execute your trades and manage your account. It means it's your responsibility to think and to see which risk you want. If you like risk, you do risky things. If you don't like risk, you stick with mutual funds, with ETFs, with stocks that doesn't move that much, and that's it. Thank you very much, and see you next video.